Good morning, it's Jeffrey Christian from CPM Group. It's Friday, the 26th of March, about 10:30 in the morning here in New York. I wanted to talk today about what does it mean that gold and silver are safe haven assets. We've been asked that several times as we've been doing these videos in the comments that are attached in YouTube to the videos after we posted them. Several investors have asked us what it means. And it's interesting that they would ask because there is a lot of confusion about that. And the confusion stems from the fact, the point that I've made numerous times throughout my life and career, gold and silver are largely unregulated markets, unlike stocks and bonds and even currency markets. And people are free to say whatever they believe about these, and they do. And there's a tremendous amount of misinformation about gold and silver. There's a book, the classic book, The Golden Constant by Roy Jastram, in which Roy says, there's no golden constant. The gold price has fluctuated sharply. I'm going to show you a chart from that book, extended by CPM Group since the 1970s when he wrote it, in a little bit. There's no golden constant. The gold price fluctuates, as does the silver price. He wrote a book called The Silver, the Restless Metal, as the follow-up to Golden Constant. These prices fluctuate sharply all the time, and they're not necessarily good inflation hedges. They're great as hedges against catastrophic inflation. And that's been extrapolated into the idea that the price is constant. And it's not constant. It fluctuates, and the purchasing power of gold and silver fluctuate all the time. And people just don't believe that. And there are all kinds of myths. Gold's a good inflation hedge. The gold purchasing power is stable. Gold trades against the dollar. And these are well circulated mistakes. They just don't happen. What it means for gold and silver, let me just see. What it means for gold and silver is not that the prices don't decline. It means that they work very well to preserve one's wealth over time. And here you can see these are the gold prices, real and nominal. The nominal is the lighter price, the real price, or the purchasing power of gold relative to consumer price inflation. The real price is in the darker blue. And these prices go back to 1968, 69, when the gold price was freed to float by Lyndon Johnson. We are this year approaching the 50th anniversary of Richard Nixon closing the government to government gold window and severing the ties between gold and the dollar and revaluing the dollar from $35 an ounce to $42 an ounce of gold, and leading to the era of floating currencies and dirty floats and clean floats of currencies and free gold prices. But in 1968, Lyndon Johnson closed the private sector gold window because there was a run on US Treasury gold that had really started in 67 and was just draining enormous amounts of gold out of the US Treasury Reserve. So they closed that window in March of 1968, almost to the day of when I'm talking here. I believe it was March 28th, if my memory serves me well, but it could have been March 26th or some. But this is the price since the gold price was freed to float in March of 1968. And you can see the blue line, the dark blue line, the real price, the purchasing power of gold has ranged from 100 to 800 over this period of time. And it's funny because you'll hear people say, well, an ounce of gold can buy a good suit now, and it could buy a good suit in 1968. And that may be true. I'm not sure if those 2 years work. But the reality is that in between, you could buy half a suit or a pair of pants, or you could buy 8 suits. The value of gold fluctuates all the time. And you can pick 2 points in time and say, well, I could have bought a Mustang, a Ford Mustang in 1970 with an ounce of gold. And now I can buy one with an ounce of gold today, or it's actually several ounces of gold. But the reality is the gold price fluctuates. And you're not a safe haven because your price stays the same. Just before I get into that, what a safe haven is, even in the long run. And these are the data really from Roy Jastrom's book, The Golden Constant, and then CPM Group has updated it. And you can see that using 2020 average price, the price of gold in 1700, slightly before Sir Isaac Newton set the prices of gold and silver for the Bank of England, in 1700, the price was about $5,200, $5,300 in 2020 terms. And we saw this long period of decline in the real price of gold because the nominal price was fixed at $22 an ounce. And this is British prices, so it was price per pound. And you saw a long period of time when the price declined. And in 1776, when Adam Smith wrote The Wealth of Nations, he has a section talking about gold prices and how gold prices will continue to lose value. And they'll lose value for for several reasons, he said. One is that you can earn interest on gold. And anytime you charge interest or earn interest on an asset, whether it's a currency or gold or silver, you depreciate the value over time by virtue of charging interest on it. You're making something out of whole cloth. In addition to that, inflation erodes the purchasing power. And what Adam Smith was talking about in 1776 was the opening up of the New World and the discovery of gold mines and silver mines in South America and North America that would be increasing the amount of gold and silver coming into Europe and would cause the price to fall. And we can see that the price basically fell in real terms until around the time when we floated the gold price. And since that time, the gold price has started to play catch up. And, in real terms, it's done very well since 1968. So that's the real price, and it fluctuates. And you're not a safe haven because your price doesn't fluctuate. You're a safe haven because you provide diversification to wealth. And that diversification comes to wealth, to the numerator of wealth. What do you own? And it comes to the denominator. Is your wealth denominated in pounds sterling or US dollars or gold or silver? And if you diversify the denominator, so you're owning some of your wealth in gold and silver, you're diversifying and you're protecting yourself from deterioration of whatever your domestic currency is or the currency in which you're holding your wealth. And the numerator is, what is it? Are you owning gold or are you owning silver? Gold and silver are a denominator, like a currency, but they're also a numerator, like stocks and bonds and real estate and other things. This is a table, a chart that we use, and we've been using this since, 1979. Makes me feel old. These are like the 6 sets of factors that drive investment demand. Gold is an inflation hedge. It's not a perfect inflation hedge, but it does protect you against catastrophic inflation. And it can help you against that gnawing 1 to 2% inflation over time, which really deteriorates purchasing power much more effectively, if you will, than those bouts of periodic inflation. It's a safe haven, which means that it gives you that diversification across all of these different things. It's a currency hedge. It doesn't trade against gold, it trades, or the dollar, it trades against currencies. It's a form of savings. It's that denominator. It's a alternative asset and a portfolio diversifier. It's something that's not a stock or a bond or a liability of somebody else. It's another type of investment. And it's a commodity. And green is there, these things are saying buy gold. Yellow is it's kind of neutral. And red is don't bother to buy gold. And we use this when we're deciding whether or not to tell our clients buy gold or sell gold. Because as you can see over here, for 2021, 2022, you can see inflation hedge, we're kind of neutral because we don't think inflation is problematic. We're much more worried about deflation than inflation. Safe haven, yeah, it's a safe haven, but things are looking better than they were in 2019, 2020 when that was green. So now it's yellow. Currency hedge, green. Savings, alternative asset, green. These are things that are compelling investors to want to buy gold this year and we think next year. And commodity is kind of neutral. But the protection comes not because the gold is highly negatively correlated. Well, when the dollar rises, gold falls, or when the stock market rises, gold falls. None of those things are actually true. The diversification value of gold and silver comes from the fact that they're uncorrelated with those. And you can look at this table here, and you can see 1970 to 2020. So that's the long picture. That's what we tend to focus on. And you get 70% correlation between gold prices, price changes, real gold price changes, and real silver price changes. But look at the others. Inflation, 9% correlation. 91% of the time, gold and inflation are not highly correlated. Trade-weighted dollar, negative 33% of the time. Dow Jones Industrial Average, negative 4%. S&P, negative 4%. T-bills and T-bonds, 0. Now, you can find periods of time when there's a higher correlation. And for example, right now, 2008 to 2020, since the global financial crisis and the Great Recession, you've seen a negative 13% correlation between T-bonds and gold price changes, changes in T-bonds versus changes in real gold prices. But the T-bill rates relationship has only changed 2%, and it's positive. It's not a negative, it's a positive. And silver is more highly correlated in the last 12 years than it has been there. All of these charts and tables occur in our gold yearbook. We launched our gold yearbook earlier this week. It is available for purchase, $160 on our website. It has all of the data, all those 4 charts and tables are in that report, along with discussion about what they mean, what's true about gold as a safe haven, and what's not true about gold as a safe haven. I have a whole bunch of slides here as an addendum to this presentation that I'm not going to bore you with today, but they almost all, if not all of them, are in the gold yearbook. And they explain a tremendous amount of information about gold's relationship to inflation, gold's relationship to stocks and bonds and interest rates. And gold is a safe haven and silver is a safe haven are not safe havens because they preserve their purchasing power. They're safe havens because they diversify your exposure to other assets. And over time, if you have a significant portion of your wealth in gold and silver, your overall wealth should do better. It should be better protected from the vagaries and turmoils of the world. And it should also have capital appreciation because these prices do rise. So the Gold Yearbook has a tremendous wealth of information about gold and what it means to be a safe haven and how it reacts to macroeconomic, financial market turmoil, political developments, pandemics. It's really worth your buying if you're going to be buying gold, investing in gold. Our Silver Yearbook will come out on May 11th. Last year's Silver Book is around. It's a great reference, but you can also wait until May 11th. You can actually pre-order it on our website. And our Platinum Group Metals Yearbook will come out in the middle of July. And we'll be talking about those things as time goes on. But all 3 of those reports talk about why it makes sense for investors to own these metals. We try not to spend a lot of time debunking myths. We get pulled into that, partly because sometimes our clients say, will you please debunk this myth? But we try not to go on and on and on about how there are spooky things, you know, and gold's purchasing power is the same today as it has ever been. And you could be an ancient Phoenician and have the same purchasing power with an ounce of gold as you have today. We try not to spend a lot of our time and attention on those distractions. We tend to focus on what's real until such time as somebody comes along and says, Jeff, you really have to pay attention to this because it's becoming a gigantic distraction in the market and people lose money on it. If you think about silver, and you look at our track record, which we've posted in recent ones on buying and selling silver. You know, the price of silver back in April of 2011 went from $36 at the beginning of the month to $50. We looked at the silver market. We said, okay, this is because of a massive roll of the May COMEX silver contract out of May into July. And if you look, ETF investors are actually selling silver as the price rises. Coin sales are way off because the price is higher and the premium is higher. But all of the buying that you're seeing is the shorts buying back their May contracts and rolling into July. So once you have that May roll behind us, we expect the silver price to fall back to $36 or so. And in fact, in the first week of May, it did. Now, if you look at the data, you see that. If you don't look at the data, if you listen to somebody who says, no, silver purchasing power is constant, there's a silver squeeze that doesn't really exist, the price is going to $100 or whatever, you keep that price, that silver at $50, and you lose your value. And it goes all the way down to 15 or 14 or 13 or 12 over the ensuing decade. We had a client who bought silver around $10 an ounce, and he wrote it up to 50. We said, you should sell your silver in late April, or buy puts against your silver, keep your silver, but buy puts and look to profit by selling those puts back if the gold price, when the silver price falls after the May roll is behind us. He didn't do that, and he still owns silver at $10 an ounce. And I'm sure he's sitting there having his vodka and water, saying that the price of silver is going to go to $100 or $200 or $1,000 because somebody said that on the internet. We have other clients who bought silver at $7 and $10 and $13, and they bought puts when the price was very high in April, and they sold those puts back for more than $10 an ounce when the price of silver fell sharply in May of 2011. And their net effective purchase price of their silver is zero because they made more selling those puts back than they did than they spent buying the silver. So that's a portfolio diversifier. That's a safe haven. And if you understand the dynamics of these markets, you can invest effectively in them. If you understand the premiums, and for example, in our gold yearbook, and it'll be in the silver yearbook, we have the premiums that are available for silver eagles, gold buffaloes. If you understand the premium and you shop around and you buy from legitimate sources, you're not going to be paying 25, 45, 50% premiums on your gold coins or your silver coins. You're going to be buying metal at a much more effective price that allows you to participate in the upside of the price. That's about it for now. Have a good weekend. Keep your hands clean, stay safe, be kind to yourself and be kind to others, and we'll talk to you next week.